Hey guys, welcome to another Trade Genius podcast. Hope you had a good weekend. Look, they had a big bailout over the weekend with the Silicon Valley Bank, but we're here to tell you that they really didn't fix anything at all. We're going to go over some data with you guys. In fact, the problem is probably going to get a lot worse. So let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Bob, how's it going? Crazy markets. I think the volatility is going to persist, and you dug into some more banking data, and it's interesting because they kind of put out there like everything's going to be okay, but quite the contrary, actually.
Yeah, here's the problem, Phil, is that the Silicon Valley Bank problem, they had two problems. They only addressed one of them. They addressed the problem where you had the mismatch of the assets and the liabilities in terms of time frame. They could have fixed Silicon Valley Bank by just doing what they did this weekend last week. Same with Signature Bank. They didn't have to let these banks blow up. The reason why they're blowing up, and the reason why a lot more are going to blow up, and the reason why we did our podcast on Friday, is that people like you and I and the rest of the world are waking up to say, hey, look, these guys have been screwing us for the last year and a half by paying us 0.5% on our money, gambling with our money, and when I can get 4 and 5% with basically treasury securities, that are quote unquote full faith, even though that's a misnomer, but it's the safest thing that you really have unless you're going to start stacking or if you're going to go all in being a Bitcoin maxi, and most people aren't, as you know. The penetration rates are at 3-4%. It's not like people have been awakened, although that might be a conversation we're going to be having here the next couple weeks anyway. But I want to show you guys a chart here. This is this is the horses running out of the barn, okay? So look at this, just cash leaving. Now, cash leaves for a couple of reasons, Phil. One, it gets spent, okay? And because companies are losing money, which is really happening. And that's part of Silicon Valley Bank's problem, is that they have a lot of startups. They've been in big cash burns. They can't raise any more cash, from investors. They can't borrow any more money because their ratios are all messed up, and so they're just going to burn it off and basically spend the money, and then that bank doesn't have any recourse because their cash to assets and the cash to liabilities are all out of whack, and then they have basically people get nervous and you get an earnings report or they report a mark to market and boom, they're gone. Well, that's most of the banks. And look where we are here. That's, approaching the 2008 kind of problem, 2000 problem. And we just started on this, okay? We don't really have this is like 2007 timeframe, and look where we already are. Part of this is that people just don't have any money, Phil. They wipe people out.
Yep.
So it's not like people are flush with cash. It's spent, it's gone. People are in fact writing up their credit cards, which is going to be a problem in the next 30, 60, 90 days, especially if people start thinking, if they bail these clowns out, why should I care? And I always think back on the Chinese, Chinese started with what's called the lay flat movement, and now they're at the get out movement. And I think we're going to see our younger kids have adopt the same attitudes. Like, what are they going to do to me? I file for bankruptcy. I can't get a credit card anyway. I don't have access to credit anyway. Why should I pay any of my bills? I don't own any assets for them to take. These guys are absolute idiots. They created a system where people don't have skin in the game anymore, and the people who have skin in the game get bailed out, and then we get taxed on it. And I think people are waking up to this fact. And this was really fast. At 48 hours, the world was mobilized to blow out of Silicon Valley Bank. Before it would take weeks and rumors and that. People didn't even wait. Mm-hmm. So these guys are behind the times in terms of how to react to these type of situations, Phil. So we're just in inning 2 of this problem. So they're just going to confuse people right now in terms of, oh, we got this under control. It was just banks. We're safe. They touted Biden out there, and he rambled on something about on the teleprompter, Yellen. I'll let you talk about Yellen in a second. Yellen comes out there, our banks are safe for security. Powell says we got a facility for this, but we won't need to backstop it, yada, yada, yada. Don't believe any of it. You guys need to take a good hard look at where your money is and get it repositioned. And reposition can mean get it into T-bills. Unfortunately, they're shoving you into the big banks. That might be the place to hide out, okay? And and you're starting to see a bit on Bitcoin. I'll let you talk about that too, Phil. So with that, I'm going to throw it back to you. I'd like to get your thoughts on that. I know you and I talked back and forth kind of all weekend on this, and I'd like to see if you agree, disagree, or you want to add your own kind of thoughts to it.
Well, I think the chart here with the change in the bank deposits was striking to me in that when it was 2008, I was talking to a high net worth client that we had, and he goes, Phil, that's when we were in the end of 2008 and things were really red. And he said, Phil, I think like the credit card issue is going to be the next shoe to drop because there were similarities. We're in a more extreme situation with people's credit card debts than we were back then. But even then, the delinquencies were ticking up. And it's like, we're in a worse case now. See, then we were already in recession. We're not even in admitted recession or one that they recognize yet. You and I both think we were probably already in one. So the metrics are much, much, much more worse on a number of things than 2008. One thing that I was looking at this at where we were in 2008, and the bank deposits weren't in bad shape. So, people may have gotten behind in their credit cards because there was layoffs and things like that. But ultimately, at the end of the day, it kind of, resolved itself. This situation is much, much more different because we've got this, like you said, the cash is just gone. It's run out. The party's over. Everybody's partying from all the easy money that we had from all of the stimulus and whatnot. It's gone. And I think the effects of the credit cards running up was just everyone, how it is. People like to maintain their lifestyle, and it's carryover from that. And I think you're going to see credit. That's the big thing now we have to probably look at is who's carrying the most risk for when these credit cards these accounts start to default in mass.
Cough, cough, Capital One.
Oh, Capital One, yeah. Yeah, so, and in this environment too, the politicians know the public is not having another '08 bailout, taxpayer-funded bailout. It's just not going to fly. You're going to have another Wall Street protest on steroids this time. So I think they know they can't really do that. So they're going to be like looking at the banks going like, sorry guys, this time you guys are going to have to buck it up. And you can kind of see they've leaned into that a little bit because they said that anybody that, first of all, on the Silicon Valley Bank, they said bondholders are wiped, shareholders are wiped. They're going to make the depositors okay, but that shortfall between whatever the bank lost and what the depositors are owed will be borne by the banks through the regulatory fees that are assigned to backstop this stuff. So it's within the banking system that they're going to be doing that. So what we don't want to see is the Fed buying treasuries for some sort of program that then provides liquidity to make these banks whole because they're too big to fail. And then that goes back to more of an '08 style, which means we ultimately are publicize the losses, privatize the gains kind of a thing. And if I think if the public catches wind of that again, watch out. So I think that's off the table for now. Now, if things get really nuts and we just start going into like Armageddon mode, people tend to be like, just fix it. Just fix it. And they might slip one in like that. But I don't think it's going to be like, and just, that's going to be swept under the rug. I think after the fact, when the dust settles, I think there's going to be a lot of blowback, and maybe even the Federal Reserve itself might be on the line because what good have they done at that point, right? So, and I think the Fed knows that. So they're treading very carefully, and it's going to be an interesting couple of weeks because we've got the Fed meeting coming up next week, Wednesday. He was banging the table, Mr. Hawkety Hawk. Now he's going to be faced with, are they going to call his bluff or not? If he's serious, then he should probably do 25 basis points. If he's just like, forget you guys deal with it, and he goes 50, I'd actually respect that. Because he's kind of doing a Volcker thing. Because it sucks because there's pain involved, but truly that's what this market needs, and it should have happened back in '08. So I would respect him for that. I don't think he's going to do it, though. I think he's going to do 25 basis points. They see more data than we can ever see, and if it's really critical under the hood, that's probably ultimately what's going to drive their decision to do what they do on Wednesday. But I think their comments going forward are going to be very telling for this market. And like you said, and it seems like every meeting's the most important meeting, but truly this meeting is the most important meeting right now because of the ramifications going forward and the stresses in the system at this point.
Yeah, look, the FDIC doesn't have enough money to be able to cover all the depositors. So, you're leveraged like 60 to 1 in terms of deposits to insurance. So,
Right.
I don't know what they think they're going to do here. We just have too much leverage in the system, period. And and they never want to do the right thing, Phil, by just creating more base money from the Treasury. It always has to go through the banking system, so those guys can get their clutches on it first.
Right.
But they need to create more base money, and they need to limit the leverage in the system. And the ultimate problem, obviously, is the fractional reserve system itself. It causes these imbalances that require them to do these crazy things that end up hurting people that are less able to first of all understand, and number two, react to it. So it's a big problem. And we have a war going on between Yellen slash Biden slash the internationalists versus the what I would call the Federal Reserve, which is more nationalistic. I'm not saying these two are two evil coins, okay, but one is Eurocentric and the other one is US-centric. And it's going to be really interesting to see how this plays out. And also, is this going to be a camel under the nose in the tent for going to something digital here to say, hey, you don't have to worry about running cash on the bank if there's no cash to run. We can manage it through digital. So I wouldn't be surprised if they're going to take a run at that at some point to see what kind of buy-in they get or see what kind of resistance they get. But it's going to be really interesting. People, be very careful. On Friday, it was the end of the world, and up until the last half hour of the market was flat for the day. So it's going to be really volatile. It's going to be really rumor-centric. It's going to be, these companies are hurting. This program is coming, and it's going to be very difficult. You're just going to have to either look out very far, like 3 to 6 months on what you want to own, or you need to be in cash just sitting and waiting to figure out, let some of this stuff play itself out, which is going to be, could be weeks or could be months as well. This is not an easy time to be an investor for sure, and it's going to be very, very interesting time to be a trader. Although there's been some great opportunities if you can swing really short-term time frames, like a day or two. I think you can make some really good money. But we'll talk about that later. We'll talk Bitcoin later. What do you think, Phil? We should talk Bitcoin later this week.
Let me touch on that real quick. So, obviously it's up a lot, and I think primarily that's from USDC conversions, people getting out of stables because they're just not quite sure. Plus, the on-ramps for stables, getting in and out of stables in fiat is going bye-bye with the closing of, say, Signature Bank, which is Coinbase's bank. And that was an interesting move on the regulators' part because, according to them, they were solvent. There was no reason to close them other than they felt like the government was clamping down on crypto on-ramps. So, and then today we noticed the alt BTC pairs. So, you can price alts in the price of Bitcoin, like Litecoin, LTC, BTC, right? All of those reverse course. And that was one thing we were noticing, that the alt BTC pricing hadn't really started to cough it up yet, which is a telltale sign of a bear market in alts and crypto in general. And we've started to see that today. So that could continue on for a while. Because you typically toward the bear in the bear cycle of crypto, you get that moment where the altcoins get bled out. There's more dominance in the Bitcoin price, and so the Bitcoin dominance shoots up. So I think what we're seeing here is potentially that flight to safety to Bitcoin from the instability of the stablecoin issues over the weekend. What I'm looking at is the high of 25,200 and change. If that can flip to support, meaning not just we poke over it a little bit and then fall back under. If it flips to support and holds price, that's significant because that typically would tell us, just because of the market structure and where we are in the halving cycle, that the lows are in and we're probably going to hold these higher levels and get out of here. But that would also mean Bitcoin's decoupling. So the question is Bitcoin really decoupling? I'm not going to say that we are yet, because we've had these momentary, divergences from the S&P 500, and they've lasted a day or two maybe, and then they kind of sink back up. So I do think the risk is that we can roll back over and kind of retrace the pump, and we have a gap on the CME futures from Friday. So I do think there's a risk for that to happen, but we won't know until, and we'll talk about this in another video, but we won't know until we see some certain things such as what the spot demand is and that sort of thing, because there is going to be a decoupling. We just, there's certain things that need to happen though for that to be a thing that we can say, yeah, for sure, get Bitcoin and don't look back.
Yeah, it's going to be very interesting couple weeks, Phil. Hey, guys, thanks for listening, and hit subscribe, hit like, hit notification. Really appreciate all the activity this weekend. We hope we're adding value to your lives. Let us know what you want us to talk about. We're wide open. As long as we can provide good information and good insight, we'll opine on it. Other than that, get ready to come to our next video. Thank you.
Thanks, guys.
Trade Genius.